Good afternoon and happy Friday to you. I wanted to give you a quick update about mortgage rates because the Fed had cut rates yet again last week, and yet again we're starting to see mortgage rates rise after the Fed rate cut. So I wanted to explain a little bit about what's going on. First and foremost, the Fed funds rate is not the same as mortgage rates, and they don't always move in lockstep with each other. I think over time that's the intended consequence, but it doesn't always work that way. The Fed has a dual mandate to basically maintain a strong maximum employment and stable prices. So the bottom line is they want to keep inflation down and keep employment at a maximum. So that's their dual mandate. The Fed adjusts interest rates to keep the economy balanced, not too hot, not too cold. If prices rise too fast, inflation, they're going to raise rates to slow things down. That's exactly what they did after the COVID pandemic. The market got too hot, inflation shot up to 9%, so they started raising rates to cool things off, and they raised them rather quickly. If people are losing jobs or spending less, which really started to occur last year, they cut rates to help the economy balance itself out and hopefully not see a hard crash with lots of layoffs and unemployment. And so what I want to show is this chart here on the left. This is a chart of a mortgage-backed securities market. I've drawn three vertical lines for the last four rate cuts dating back to September of last year. And what I really want to point out is to the left of the line for last September, you'll see that the price of the mortgage bond went up. So from left to right, it's going up, really starting from about April. And basically what that is that's when employment started to show weakness and the market started to price in the fact that they thought the Fed was going to have to cut rates in order to help the labor market. And so the market improved in anticipation of the Fed cut. The Fed cut 50 basis points in September. Then we saw mortgage rates go up at the announcement, which is not all that uncommon. Then they cut again by a quarter, and we actually saw a little bit of improvement in mortgage rates. Then they started to deteriorate again. They Fed cut again, and mortgage rates deteriorated further. The bottom line is the market for mortgage-backed securities is always going to trade based on economic data, inflation, the employment market, geopolitical events, wars, you name it. There's a lot of things that go into it, but you can see there's a lot of volatility. Fast forward to this year, in August, an employment number came out that was very, very weak. And as a result, all of a sudden the market priced in a Fed rate cut. We saw the market improve rather dramatically from August through last week. The Fed cut last week. Since the Fed cut last week, we've had several economic announcements come out that are showing a little bit stronger economy than maybe we had anticipated. So now all of a sudden the market is pricing in the fact that the Fed may not cut anymore this year. There's more numbers that come out all the time. Every week we have economic data come out. The next big announcement is October 3rd. There's going to be an employment number coming out that day. That day will determine whether or not we're likely to see more Fed cuts this year. If it's a weak number, maybe we see mortgage rates improve further. If it's a strong employment number, chances are the Fed's going to stay put and not cut again, and we could see mortgage rates either stabilize or maybe go up in the near term. Bottom line, there's a lot that goes into this. If you've got questions or concerns, we're here to help, but I just wanted to provide a little color on it. Real quick on the right here, this is the the Freddie Mac weekly survey about average rates nationwide. And you'll see that the 30-year fixed rate is 6.3 as of yesterday, and the 15-year fixed is about 5.5 as of yesterday. And the market's been pretty flat today, so these are probably pretty accurate. Still very, very good, much, much better than they were last year. If you've got anybody looking to buy a house, now may be a great time to consider because rates have come down quite a bit. Have a great weekend. Take care. Bye-bye.